And we're glad to have you here with us on the Retirement Key, continuing the conversation with Abe Abich, financial advisor and founder of Abich Financial Services. Of course, if you have questions about things you hear Abe talk about in this or other podcast episodes, you can always find us at theretirementkey.com. We also have links posted in the show notes. You can just click there if it's more convenient. Or again, find us anytime at theretirementkey.com. Well, and I was about to say, the whole idea about 401k conversions, Roth conversations, I feel like it's been the name of the game for so much of the financial conversation has been around this concept for the past few years, just because of the tax brackets that we're currently in.
Sure.
And something that we have talked about on your weekly radio program, on this podcast, as well as the idea of now that President-elect Trump will be going back into office in the new year in 2025. Many believe he has said he's going to extend the tax cuts that were implemented in 2017. Mm-hmm. And while we can be hopeful, Abe, so many of us are worried about the national debt. Where's the national debt at this date?
36
we're recording
plus,
the podcast.
36 plus trillion.
Yeah. Okay.
Yeah. So you go to usdebtclock.org and get scared pretty quickly.
Don't go there. Right. It's very upsetting.
If you go there, be seated. Sit down and then open up at your own risk. usdebtclock.org. You're going to see a pretty scary sight. Over $36 trillion in national debt.
Yeah.
So,
and it's just a rotating clock, right? Isn't that the thing? It's just tickering.
Yeah. Yeah.
It feels out of control.
Yeah.
And I think that probably that's the reason why it is out of control. And we as individual consumers and savers feel that there's nothing we can do to control it. It's in somebody else's hands. So we can be as responsible as we want. And yet we're walking around with, we feel like targets on our back because we have worked hard to save $3, $4, $5 million to our 401ks.
That's true. But what you can control, Heather, is where you put your money, right? Not only how you invest it, but then what type of account you contribute to. So in your 401k at work, you can choose the pre-tax side, get a tax break and deduction this year, or you can choose the post-tax side. Most 401k plans and companies offer a Roth version of the 401k, just like the TSP. So you have a choice to make. Am I going to take that tax break today? Because, especially if you're younger, do you really think that 30, 40 years from now, if you're in your 20s, 30s, 40s, taxes will be lower when you retire 20 to 30, 40 years from now? Probably not. And so you got choices to make. You can control part of it. You definitely can't control, Congress spending money on everything that they spend money on, but you can control how you invest and where you put your money.
All right. Let's talk about then the how-tos of how we can control, because a recent study from Investor.com says people wanting advice on rolling over 401ks to personal IRAs, just this one concept. People are seeking information on the how-tos of it. It was up 150%.
Yep.
Topping $760 billion is that rollover that people are looking at. There is so much, again, concern causing so much interest. So what's involved in a rollover process, one, and how can it help a person planning for their retirement? And I guess the third question is, how do you help?
Yeah, I'll give you an example. Just earlier today, a gentleman was in with $2.5 million in his TSP. Yep. He had $2.5 million in his TSP and a couple of accounts with First Command, which is typically known as the financial planning firm for the military. And he's a former U.S. Navy captain and set up accounts with them 20, 30 years ago, has kept them, hasn't been thrilled with those accounts, but still has them, looking for other opportunities. And $2.5 million of most of his nest egg in the TSP.
Yeah.
Well, he met with Fisher Investments, he met with Edelman Financial and ourselves, and maybe one other firm too, I'm not sure. But what he's learned at the very least in those meetings is that there's a world of opportunity outside of the TSP, which is the government's 401k, and outside of 401ks in general. Yeah. So if there's a world of opportunity in terms of funds and all kinds of strategy outside of your company 401k plan, then maybe you should consider it if you're eligible to roll over part or all of your 401k or TSP into an IRA outside of your company plan. So a rollover is just that. Okay. If you're working for a company and you're still employed by the company in which you have a 401k, typically you cannot initiate a rollover in part or full until you're 59 and a half years old or older. Most 401k plans allow you to do that. And that's because the IRS says, well, Heather, you're almost 60. If you want to retire at 65, 66, you got 5 or 6 years till you retire. You deserve to have more options available to you outside of your workplace plan.
Yep.
So if your plan allows it, and you're usually 59 and a half or older, working for that company where you have a plan, then you can roll over that plan in part or full into typically a traditional IRA or a Roth, if you've got a Roth portion of the 401k, without tax or penalty.
Okay.
And if you're still working for that company, you would keep the account open, continue to contribute, continue to get the match. And then if you're a few years away from retirement, maybe we do that type of thing once per year, once every few years. If you've got an orphaned 401k, which a lot of people do, or an orphaned TSP, that's what we call it, right? You work for the government as a civilian, as a former military, you're working for the government 10, 20 years. You're not there anymore. You have an orphaned old TSP. You work for a company in the defense contracting world or any industry for a year, 6 months, 5 years, 10 years, you're going to have all of these 401ks that start to add up. Well, it can be hard to keep track of all these accounts, right? But if you consolidate and roll them over into an IRA or IRAs, you can go from a handful of accounts down to 1 or 2. That's kind of one of the concepts. Also, when you go and roll over from a 401k into a traditional IRA, if you're eligible to do so, again, there's a world of opportunity outside of that company plan and in an IRA on the Fidelity platform, on the Charles Schwab platform, on all these major custodians platforms. There are literally thousands of options that an investor can choose from. Whereas in a 401k or TSP, typically there are anywhere from 5 to 15, maybe 20 options to choose from. Sometimes it can be costly options too.
Right.
The funds inside 401ks can typically be pretty expensive, a lot more expensive than maybe buying a fund on your own on a major platform like Fidelity or Schwab. Then once the money is out of the 401k and rolled over into a traditional IRA, there's even more planning that can be done besides the investment allocation. You can do things like Roth conversions, where typically in most company plans and the TSP and most 401ks, you can't do an in-plan conversion, like an in-plan Roth conversion.
Okay.
So typically that money has to be rolled over, come out of the company plan into a traditional IRA, and from the traditional IRA into the Roth.
Okay.
These are just 3 or 4 reasons and ideas I'm thinking of off the top of my head here that would be reasons to consider streamlining, consolidating, rolling over, transferring dollars under the management of a financial professional who can help you with various things.
Something else that was pointed out to me at some point in the last few years was the idea you talk about an orphaned 401k or an orphaned TSP and the costs that are in those funds. A lot of times employers will take on some of those fees for their employee. They'll pay for like half of the fee cost. But when you leave that employer, they stop paying for the fee portion they were paying. So yet another reason to go find your orphaned old 401ks that are sitting around out there, because you could be paying double the amount of fees that you thought you were just because the previous employer is no longer going to pay for fees when you're not working for them anymore.
It's very true, Heather. And when you look at the difference in fund costs, right? Let's say your average fund cost in a 401k plan, let's just say this is your 401k plan. The average fund cost is 50 basis points, or that'd be a half of 1%.
Yeah.
Whereas on maybe the Vanguard platform or Schwab or Fidelity, your all-in cost might be 10 basis points. Yeah. That's a difference of 40 basis points. And when you're talking $100,000, couple $100,000, couple $1 million, 40 basis points, close to a half a percent over 10, 20, 30 years, it could be
hundreds of thousands.
Definitely thousands, for sure, potentially hundreds of thousands of dollars back in someone's portfolio simply by watching the costs and the fees inside fund expenses. We've nicknamed them termites before, right? Termites can eat into the foundation of your house. Fund costs that are higher than what they need to be can eat into your overall return and essentially eat into your family's money down the road and portfolio. And oftentimes what we'll see, Heather, is, people come in and they'll have mutual funds that they bought 20 years ago, where those mutual funds were great, 15, 20 years ago, big mutual fund family names, maybe the returns have been decent, but the fund expense is 40 basis points, 70 basis points. Sometimes we see fund costs over 1%, which could be more than a client will pay us in financial advisor fee.
And they're not even getting any advice.
Now that's just backwards, isn't it? That the cost of the fund would be more than you're paying a professional for advice. That's totally backwards. And we see that oftentimes.
Yeah.
So there's so much to consider. And a lot of this is kind of uncovered when a potential client comes in for a complimentary second opinion. We call it a where do I stand plan. Part of that where do I stand plan when we're analyzing everything is obviously an analysis of the investments. We run everyone's investments through Morningstar and Riskalyze, and it basically tells someone, Heather, here's exactly what you have in stocks. Here's exactly what you have in bonds. Here's what you have in mutual funds. Here's what your risk is. Here's what your cost is. If we have another 2008, here's what you're likely to lose. If we have a really, really good year, like this year, here's what you're likely to make. It might be 20 or 30% on the up. It could be 30, 40 to 50% losses potentially on the down. Is that something you want to deal with, Mr. and Mrs. Client, as you head into retirement, as you're telling me you want to pull the trigger in the next 2 years? No, it's not usually what people want. Right. So it's an eye-opener, and a lot of people have never had one done. A lot of people haven't had one done in a long time. Yeah. If you're working with an advisor from another firm, most of our clients come over to us from existing relationships. It's typically a phase one accumulation-based firm where they're coming over to us from that type of firm because they have the money to retire with dignity and confidence, but they don't have a plan. They've got an investment plan, a savings plan, but they're missing all the other components. And then our successful do-it-yourself investors, what they're realizing is that, again, I knew how to grow it. I knew how to invest it. Sometimes you're seeing puts and calls and options and all this fancy stuff. I know how to make money, Abe, but I'm not really sure how to distribute it, how to plan for taxes and all these things, how to preserve it, how to keep it. Yeah. Because with that type of investing strategy, you can potentially have huge losses as well. So there's no wonder that, 401k rollovers and transfers and all these things are just continuing to tick up every single year. So people have more options. Yep. And we can help you with those as well. If you're watching right now and you say, you know what, I've got a bunch of 401ks, Abe, or I just hit 59 and a half, or I'm retiring in 2, 3, 4 years, 5 to 7 years or less from now, especially if you're down to a year or two, man, you've really got to pay attention to this. Put together a plan to help you transition successfully over into retirement. This is all part of those first steps.
Also, a great way to get started, educating yourself, figuring out the steps to take, figuring out what questions to ask, what things you need to know about, is by reading Abe's book, The Retirement Mountain, The 7 Steps to a Long-Lasting Retirement. It's chock full of information, but the good news for you is it's only about 100 pages long. You can read it in just a couple of hours on the weekend. Yep. So a great way to perhaps kickstart some New Year's resolutions as far as getting your financial house in order. If 2025 is going to be your year, or if you know for sure that it's your year to retire, but what have you done to get the retirement plan in place? Let's get to work helping you sort all of that out. TheRetirementKey.com is our website where you can go to learn more about Abich Financial Services, plan a time for a complimentary review. Also learn more about getting your free copy of Abe's book. If you click on the media tab and choose the book option there, you can find it on Amazon, or if you come in for an appointment, we will give you a free copy of this book and would love to help you get started on that education. So we also have links posted in the show notes. If it's more convenient, you can just click there. Or again, let's get to work helping you get started, figuring all of these things out for your financial future. Find us at TheRetirementKey.com.